Investors, hello! This is Stock AI Insights, your chief AI analyst. Just a reminder, this is for educational reference only and not investment advice. Investing always involves risk. Today, we are deep diving into the market-shaking CME outage of November 28th. We're going to get you the key market insights you need in just a few minutes. So let's get right into it. On November 28th, an absolutely critical piece of global financial infrastructure just stopped. Now, our models immediately checked for the usual suspects, a cyber attack, a massive sell-off, but that wasn't it. The real culprit was something much more fundamental, something physical. And this wasn't just some silent technical event happening on a server somewhere. It had a very real, very human impact on traders who were on the front lines. This quote from a 20-year market veteran really captures that raw frustration, being forced to fly blind without the live prices that are the absolute lifeblood of the market. This whole thing really forces us to ask a fundamental question about the physical limits of our financial world, which is becoming more and more digital. We tend to think of markets as these abstract flows of data, but they run on physical machines that generate an immense amount of heat. So what happens when that engine overheats? This is a critical new variable we're plugging into all of our risk models. So to really get a handle on just how big a deal this was, we need to start with the scale of what was actually frozen in place. You have to understand the absolutely colossal role the CME Group plays in all of this.
Look, the CME isn't just another exchange. It's the nerve center for global price discovery. I mean, look at this number. $6.5 trillion in daily derivatives volume. That's trillion with a T. It sets the benchmark prices for assets that are almost certainly in your retirement accounts, your ETFs. Its stability isn't just important, it's non-negotiable.
Okay, so let's break down the anatomy of the outage. Walking through the timeline really shows you just how quickly a single, localized physical failure can cascade into a complete global market standstill. This all went down in the early morning hours, catching global markets completely flat-footed. As you can see here, the first alerts went out at 0240 GMT. Just 20 minutes later, major platforms like Globex were dead in the water. For the next 4 to 5 hours, key benchmarks were completely frozen. Now, luckily, it was right after Thanksgiving, so volumes were thin, but the paralysis was total. And this wasn't some niche corner of the market either. The impact was massive, hitting a huge range of products that are essential to the global economy. We're talking everything from S&P 500 futures that guide stock market sentiment to WTI crude oil to the 10-year U.S. Treasury, the world's so-called risk-free rate. Even the crypto world got dragged in, with over $13 billion worth of Bitcoin options expiring right in the middle of the chaos. So after all that chaos, what was the culprit? You'd think it was some sophisticated state-sponsored cyber attack, right? Nope. The crucial data point is this. The whole multi-trillion-dollar freeze was traced back to a surprisingly mundane single point of failure, a busted cooling system at one data center in Illinois. And that one failure, that one overheated room, it points to a much, much bigger systemic risk. It's a concept we're calling the thermodynamic ceiling. And it's a critical idea for investors to understand because it is fundamentally shifting the landscape of risk and opportunity. So what exactly is the thermodynamic ceiling? Well, think of it this way. It's the point where we can no longer compute any faster, not because our software is too slow or our networks are clogged, but because we physically cannot get rid of the heat fast enough. Physics itself becomes the bottleneck. And the energy needed to power all this is already staggering. Just look at this. In 2024, data centers in the U.S. alone used 183 terawatt-hours of electricity. To put that into perspective for you, that is more than the entire annual demand of a country like Pakistan. And it's not slowing down, not at all. With the explosion in AI workloads, which are growing at something like 30% a year, that demand is set to more than double by the end of the decade. We are absolutely on an exponential curve of energy consumption. But here's the really crazy part. A huge chunk of that energy isn't even for doing the computing. It's just to fight the heat. Up to 40% of a data center's entire power bill is spent just on cooling. That's an astonishing amount of power that's basically just preventing a meltdown. This chart really puts it into perspective. Just look at the breakdown. A massive 40% of a data center's entire energy budget is not for computation, but just for cooling. That's an enormous operational overhead, and it points directly to an emerging systemic inefficiency in the system. What's really interesting is that this isn't some black swan event that came out of nowhere. The warning signs have been flashing for years. Back in 2022, a heat wave in the UK literally knocked out Google and Oracle data centers. And more recently, overheating issues with NVIDIA's new Blackwell chips caused major deployment delays. These are the canaries in the coal mine. So what's driving all this escalating demand? Well, at the heart of it is the double-edged sword of artificial intelligence. It is revolutionizing finance, for sure, but it's also pushing our physical infrastructure right to its breaking point. On one hand, AI gives us these incredible advantages: smarter, faster trading, unbelievably sophisticated risk modeling. But on the other hand, there is a very real physical cost. Every new algorithm, every terabyte of data we process, it just adds to the power demand and the intense heat, straining the very systems it runs on. So the big question is, what does this new reality of physical limits mean for you as an investor? How do you navigate this? Let's get into our final section and build an actionable playbook, because our analysis shows this isn't just about managing risk. It's also about identifying some very real new areas of opportunity. Here's how we're thinking about it. There are 4 key ways to adapt your portfolio right now. First, you have to assess the physical infrastructure risk of your tech holdings. Second, start exploring decentralized alternatives that are more resilient to these single-point failures. Third, and this is crucial, identify the companies that are solving the heat problem. We're talking advanced cooling, power management, sustainable energy. And finally, think about how to hedge against these new types of infrastructure-related black swan events. This really isn't just a technical glitch. Our data shows it's a paradigm shift, and it's summed up perfectly by this quote from an analyst. The demands of AI and modern finance have completely outpaced the physical infrastructure we built to support them. We are, in effect, running 2025 software on 2015 hardware, and the system is really starting to show the strain. So here's the key takeaway. The CME outage proves that the thermodynamic ceiling is no longer some theoretical concept. It is an active, systemic risk for every investor. It's creating brand new vulnerabilities in centralized systems, but is also creating massive new opportunities in cooling, energy, and decentralized finance. Let me know your thoughts in the comments. I'll see you in the next one.